There is a number that does not fit the story Microsoft has been telling for the past 2 years. Not the $80 billion in data center spending the company announced for fiscal year 2025, not the billions flowing into OpenAI, not the aggressive capacity buildout that executives described quarter after quarter as historic and unprecedented. The number that does not fit is smaller. Roughly $2 billion in data center leases that Microsoft quietly walked away from in early 2025, across at least 2 countries, without a press release, without an explanation from the CEO, and without a single analyst on a major earnings call asking about it directly. That silence is the story. If you track the gap between what AI companies announce and what they actually build, between the capital committed and the infrastructure that eventually comes online, subscribe now and turn on notifications. That gap is widening in ways that matter, and this channel covers every time it does. The cancellations were first reported by TD Cowen analyst Michael Elias and his team in February 2025, based on channel checks with real estate and data center leasing sources. The finding was specific. Microsoft had pulled back on leased colocation capacity, totaling roughly $2 billion in the United States and Europe. Not delayed, canceled. The distinction matters because data center leases, once signed, are not the kind of contract you exit without a reason. They carry long commitments, they require significant upfront costs, and pulling out signals something about demand forecasts that the leaseholder does not want to say out loud. Microsoft did not deny it. The company's response, filtered through spokespeople and later through carefully worded executive statements, was essentially that capacity planning is dynamic and the company continues to invest aggressively in infrastructure, which is technically true and also tells you almost nothing. So what actually happened here? To understand the cancellations, you have to go back to late 2024, when multiple signals were already pointing in a direction that Microsoft's public narrative was not acknowledging. The company had been leasing colocation data center space at a pace calibrated to a very specific demand curve. The assumption that Azure AI services, particularly those built on top of OpenAI models, would see adoption rates steep enough to fill the capacity being booked, that assumption was built into the capital commitments. It was built into the leases. But by the fourth quarter of 2024, something was visibly off. Azure's AI-attributed revenue growth, while real, was not tracking the curve that would justify the full scope of the build-out. Microsoft's own cloud growth numbers, reported in the October 2024 earnings call, came in slightly below analyst expectations, with Azure growing at around 33% year-over-year. That is a strong number by any normal standard. The problem is it was not the number that validated the infrastructure investment thesis Microsoft had been building. And when you have already locked in leases priced against a more aggressive growth trajectory, a 33% real number against a 35 or 36% modeled number is not just a small miss, it is a capacity mismatch. That is how you end up canceling $2 billion in leases without ever saying you overbuilt. Here is the part that does not get enough attention. Microsoft, in its January 2025 earnings call, had CFO Amy Hood reaffirm the company's capital expenditure guidance for fiscal year 2025, pointing to continued significant investment in AI infrastructure. Satya Nadella said publicly that the company had seen no pullback in AI demand. These statements were made in the same window in which, according to TD Cowen's reporting, the lease cancellations were already underway or had recently concluded. An extraordinary thing to reconcile, but there it is. The geography of the cancellations adds texture to this. The pullback was concentrated in leased colocation space, not in Microsoft's own data centers. That distinction is meaningful. When a hyperscaler cancels its own construction projects, it signals a fundamental rethink of infrastructure strategy. When it cancels colocation leases, it signals something more surgical. The company is trimming capacity it had reserved in specific regions where projected demand did not materialize on schedule. Sources cited in coverage by the information and later corroborated by reporting from Bloomberg suggested that the affected leases were concentrated in markets where Microsoft had been rapidly expanding capacity to serve European enterprise customers adopting Azure OpenAI services. The European piece is particularly interesting because it ties directly to a dynamic that was playing out simultaneously in the regulatory and competitive space. European enterprise adoption of Azure OpenAI had been slower than projected, in part because of data sovereignty concerns, in part because of the European AI Act creating compliance uncertainty, and in part because competitors, including Google Cloud and AWS, had been aggressively pricing their own AI services to win the same customers Microsoft was counting on. When the demand in a region grows slower than your lease commitments, you either fill the capacity with something else or you exit. Microsoft chose to exit. Now, here is what makes the timing especially consequential. These cancellations were happening in roughly the same period that Microsoft was publicly defending its investment in OpenAI, having already committed a reported $13 billion to the company across multiple tranches, with a new multi-billion-dollar tranche being structured. The message to the market was, "We are all in on AI infrastructure." The message implicit in the lease cancellations was, "But not quite as all, in as we were a few months ago in these specific markets with this specific demand profile." That tension is not unique to Microsoft. It is the core tension of the entire hyperscaler infrastructure boom. You build ahead of demand because if you do not, you lose to a competitor who did. But building ahead of demand at the scale of tens of billions of dollars per year means that any shortfall in adoption creates an enormous overhang of underutilized capacity. And underutilized data center capacity does not just sit quietly. It burns capital through lease payments, energy costs, and depreciation every single month. The analyst community's reaction to the TD Cowen findings was revealing. Some read the cancellations as bearish, evidence that the AI infrastructure supercycle was already encountering demand reality. Others, including several that second interpretation is not wrong, but it requires you to ignore the fact that Microsoft had been telling investors those racks were going to be needed. And then there is the OpenAI relationship sitting in the middle of all of this. A significant portion of Azure's AI capacity is effectively reserved for OpenAI workloads, the compute that runs ChatGPT, the API traffic from OpenAI's enterprise customers, the training runs for future models. When Microsoft pulls back on capacity, it is not just making a statement about its own product demand, it is making a statement about how much OpenAI traffic it is actually absorbing. TD Cowen's analysts noted in their February 2025 report that the cancellations did not appear to affect capacity dedicated to OpenAI workloads specifically, but the line between general Azure AI capacity and OpenAI reserved capacity is not as clean as that distinction implies. They share physical infrastructure, they draw from the same regional pool. OpenAI, for its part, was simultaneously in the middle of securing a $40 billion funding round led by SoftBank, a round that valued the company at $300 billion and was described in coverage by the Wall Street Journal and Bloomberg as one of the largest private funding rounds in history. The round closed in March 2025. The optics of Microsoft canceling data center leases while OpenAI is raising at $300 billion is the kind of dissonance that usually means one of two things. Either the demand story is more complicated than the valuation implies, or the two stories are operating on entirely different timelines and entirely different assumptions about when the revenue arrives. There is a version of this where Microsoft's pullback is actually rational optimization. The argument goes like this. Microsoft overleased in 2023 and early 2024 when every hyperscaler was in a land grab mentality, terrified of being capacity constrained if AI demand spiked. The demand came, but not quite at the pace or in the geographic distribution the leases assumed. So Microsoft is right-sizing. It is still spending $80 billion in fiscal year 2025. It is still the single largest infrastructure backer of the AI ecosystem. $2 billion out of $80 billion is 2.5%. Round error. Noise. That version is available to you if you want to take it. But here is what it requires you to ignore. It requires you to ignore that Microsoft's public guidance gave no indication this adjustment was coming. It requires you to ignore that the cancellations were surfaced not by Microsoft but by third-party channel checks, which means Microsoft had no intention of volunteering the information. It requires you to ignore that the same period saw Microsoft announce layoffs of roughly 6,000 employees in May 2025, one of the largest workforce reductions in the company's recent history, with cuts concentrated in roles tied to product and engineering, according to reporting from multiple outlets including Bloomberg and CNBC. A company simultaneously cutting headcount and quietly trimming data center leases is sending a signal about cost discipline that does not align with the full throttle on AI narrative. The layoffs are worth pausing on. 6,000 people is not a rounding error in a workforce of approximately 228,000. And the timing, coming in the same fiscal year as both the data center cancellations and continued aggressive capital expenditure commitments, suggests a company managing a real tension between the cost base it built for an AI growth trajectory and the revenue that trajectory has actually produced so far. Microsoft has not said this explicitly, but the arithmetic is visible. What happens next is not a mystery, exactly. It is a question of sequencing. Microsoft's next major earnings report will give analysts the Azure growth numbers they need to model whether the demand shortfall that apparently drove the lease cancellations has stabilized or deepened. If Azure AI revenue accelerates sharply in the next 1 or 2 quarters, the cancellations look like a small and smart correction. If Azure growth continues to run below the pace needed to justify $80 billion in annual infrastructure spending, the $2 billion in canceled leases starts to look like the first visible symptom of something larger. The quarter that will answer that question is the one ending June 2025, with results expected in late July. That earnings call is the first hard data point that will either validate or complicate the story Microsoft has been telling. Every data center operator, every colocation provider, every hyperscaler shareholder will be running the same calculation. Did the demand come in or did it not? There is a broader question underneath all of this that the industry has not answered and has largely avoided asking publicly. The hyperscalers, all of them combined, are committing somewhere between $300 and $400 billion in capital expenditure for calendar year 2025, according to aggregated estimates from analysts at Goldman Sachs and Morgan Stanley. That capital is justified by a demand forecast for AI services that does not yet fully exist in the revenue line of any of these companies. Microsoft, Google, Amazon, Meta, none of them have AI-specific revenue that justifies the infrastructure at current scale. They are betting on a demand curve that is still forming. When one of them quietly cancels $2 billion in leases and does not mention it, it is not just a footnote. It is information about where that curve might actually be going. The question worth leaving with you is this. If Microsoft, the company with arguably the most direct line to monetizable AI demand through its OpenAI partnership and its Office and Azure integrations, is trimming capacity in early 2025, what does that tell you about the confidence the other hyperscalers should have in the demand forecasts sitting underneath their own commitments? If that question interests you, the comment section is the right place to put your answer, and there is no better argument for subscribing right now than the fact that the July earnings calls are going to tell us a great deal. The $2 billion is a small number in a very large story. But small numbers have a way of compounding when the story they belong to is not quite what it was